Well, a very good morning to all, and welcome to the 2023 Cattle Projections webinar. We just will give just a little bit more time as those who have registered for this webinar are still coming online, and we'll start very shortly. Well, good morning to all. Those who are online at the present stage for the MLA 2023 Cattle Projections webinar. We've still got more registrations that are coming on as I speak, so we'll get going very shortly. I think we're probably right to go now. So, good morning and welcome to MLA's 2023 Cattle Projections webinar. Today we will be discussing MLA's first cattle projections release of 2023, with 2023 being a year of transition for the national herd into a growth phase. Slaughter is forecast to improve and the market will find a new position in terms of prices. Thanks to all for taking the time to attend. My name is Brendan Wade and I'll be your moderator today. I am MLA's LMO manager looking after 29 livestock market officers that report on 50 sale yards nationally. The team presenting today, talking you through the January release of cattle projections, will be Steve Bignell, the Market Information Manager, Ripley Atkinson, MLA's Senior Market Information Analyst, and Tim Jackson, the Business Analyst for the Market Information team. Before we do start the presentation, I'll just get each of them to give a brief on their background, starting with Steve Bignell.
Thanks, Brendan. Like Brendan said, name's Steve Bignell. I'm the Market Information and NLRS Manager at MLA. So my team look after all the supply, production and pricing insights for both sheep and cattle. And a bit about myself, originally I'm from a sheep and cropping farm in Coconut, WA.
Thanks, Stephen. Ripley Atkinson.
Yeah, thanks, Brendan, and good morning, everyone. Thank you for the introduction, Ripley Atkinson. I'm from Tamworth in northwest New South Wales, and my role within MLA is to look after the sheep and cattle projections and the delivery and development of those, the state of the industries report, the lot feeding brief, and then also general day-to-day analysis of Australia's livestock markets, and included in that's presentations both to domestic and international stakeholders.
Thanks, Ripley. And Tim Jackson.
Thanks, Brendan. And hi, everyone. My name is Tim Jackson. I'm a business analyst in the market information team here at MLA from Sydney. And as a business analyst, I handle a lot of the export market reporting information and generally kind of oversees supply stuff, which is a lot of what we're going to be talking about today. So how that intersects with what we're doing in Australia and how that then relates to price.
Thanks, Tim. Contact details will be made available in the chat function today. So if you have any supply, price or production related inquiries, please reach out and we'll be happy to assist. Before we do start, I'll cover a few housekeeping points regarding today's presentation. All participants will be on mute throughout this presentation. There will be time for questions at the end of the presentation. Feel free to enter your questions at any time throughout the presentation. So as you have a question, please put that question through. You haven't got to wait till after the presenters have presented. So enter your questions. You have a Q&A function, which is located at the top right of your screen. We will endeavour to answer all questions, and any questions that we don't get to will be taken on notice and they will be responded to. Please also note that this webinar is being recorded. A copy of the recording will be uploaded onto the MLA's website, and this will be uploaded to the website and YouTube within 24 hours. The full projections document has been released on Tuesday on MLA's website under the Trends and Analysis page. They'll also be circulated in tomorrow's edition of MLA Weekly Email Newsletter, The Weekly. At the end of this webinar, you will be prompted to fill out a free feedback survey. Please take time to complete this, as it does assist the team in improving its offering of content for industry to meet its needs. So we'll launch into the 2023 cattle projections, and first up, I'll probably run to you, Steve. We know the weather plays a critical role in influencing the national herd size. What are the BOM forecasts for 23, and how has this played a role in your modelling for the cattle herd?
Thanks, Brendan. So what we do when we're preparing our projections is we look at the past weather, and then we look at what the Bureau of Meteorology forecast going forward. As we know, the wet season that we're in has been quite fruitful for large parts of Northern Australia, with a lot of areas in Queensland, Northern Territory and the Kimberley receiving above average rainfall. So that is something that is underpinning our models, that we had a strong wet season this year. Looking forward, when we're going forward, the BOM have predicted a return to neutral or El Nino conditions by the middle of the year. BOM do put a caveat out that their El Nino predictions in the middle of the year and out that far are not necessarily as reliable. So that is what they're predicting. So where we've come from is we've had 3 La Ninas, and we've got a significant amount of pasture, water, soil moisture around. We had a strong wet season. So even if we do transition into a period of neutral and El Nino conditions in 2023, we don't expect there to be any significant liquidation of the herd on those bases. Our model does have an El Nino factored in for the next 18 months, and that's what we'll see when we get to the herd projections, is a tapering off of herd growth in from 2023 out to 2025. There is the Kimberley floods that did happen. At this moment, there isn't enough data to quantify the impact that will have on the projections.
Okay, I'll begin with asking you about assumptions which underpin the cattle projections. Seemingly, there are a number of macroeconomic drivers affecting the cattle market at present. So, Steve, what do the projections see as the key macro issues affecting the Australian beef industry in 2023?
So we look at a few macro issues that will impact the whole supply chain. There were 6 identified this year: the interest rates, input prices, exchange rate, farm management deposit levels, inflation and employment. When we look across at interest rates, all the big 4 banks in Australia do expect interest rate rises to increase in 2023, albeit a little bit smaller than the rate rises we experienced in 2022. What that will mean, increased interest rates, is it will have a bigger impact on those areas in the supply chain that are more reliant on debt financing. So it could impact processors and retailers and producers that have got high levels of debt. Looking at a producer level, nationally cattle businesses are quite well placed financially. On the most recent ABARES data, the debt to equity ratio for national cattle farms was 94%. Last year, farm debt fell by the greatest amount since 1990, and there, on average, each cattle farm in Australia has $220,000 in liquid assets. So interest rates will affect parts of the supply chain, but overwhelmingly there are really positives around the cash position of farms. The other one is exchange rates. Exchange rates are sitting at 0.7 of a US dollar. So they're sitting where they were essentially last year, down 2%, which makes us slightly more competitive than we were. What we do look at as well is the trade weighted index, which looks at the Australian exchange rate compared to a range of currencies and weights them according to the size of trade we do with those countries. At the moment, it's sitting at 61.9, down from 64 last year, the TWI. So that means that Australia is more competitive on the global stage this year than it was last year. The third thing we looked at was farm management deposits, or FMDs. Farm management deposits are a tool that allow farmers to smooth out income from good years into bad years and to have that cash available at a later date. With cash farm management deposits, there's currently $1.17 billion sitting in farm management deposits for cattle farms. This is up 34% on where it was in December 2019. So it means that if there was seasonal conditions to change or market conditions were to change, cattle producing businesses in Australia have got a availability of funds, which is a really encouraging piece, and again sort of underpins why we have strong herd growth this year. Inflation will be an issue. It's the 7.8% last year, which is the highest since 1990. What that means is consumers at a retail level will be more price sensitive. What it does mean for producers and processors and retailers is that the input cost will increase. That leads into input costs. We've got fuel costs and electricity are the two that we highlighted this year. RBA, the Reserve Bank of Australia, estimates that electricity prices will be 20 to 30% higher in 2023 than they were in 2022. So that will have a big impact on parts of the supply chain and their margins. The fuel price is up 7.9% on where it was last year at 179 cents a litre. So that means fuel costs along the supply chain from farm and right through to processors will increase. And the last issue that we look at is really employment, and we'll talk on this throughout the day, but employment is going to be a key issue that is addressed this year, is that with employment, if Australia can successfully secure labour this year, then we can see a growth in slaughter numbers and processing throughput. But if we can't secure labour, then there is going to be the possibility that slaughter could still remain constrained.
Good. We'll move to the national herd landscape. Ripley, can you explain the current situation of the national herd and what does the picture look like?
Yeah, thanks, Brendan. So the situation for the national herd in 2023, it'll be recognised as a year of transition. We're moving from a rebuild, and now any increase in numbers will be considered beyond that, and it's actually a growth of the national herd beyond 10-year averages. So looking at our production systems in the south, New South Wales will be a key contributor this year again to the increase in the herd size and play a significant role, while Victoria, South Australia and Southern WA to differing extents will also contribute dependent on movement of stock and things like that. So when we look to the north into Queensland and the northern production systems, we're expecting or the assumption is for an average seasonal year for those production systems after the rebuild up there gained significant improvement and momentum. So we know the retention of females was high last year, and that's going to contribute to that rebuild developing and growing.
Very good. So if we move on from there, Ripley, you've explained that 2023 will be a transitional year to growth stage for the herd, but what are the drivers of that transition?
There's three key things, Brendan, that are the hallmarks of why we're seeing this growth. Firstly, the production fundamentals. Secondly, the stock turnoff rate. And thirdly, the female slaughter rate. And I'll begin with looking at the production fundamentals. So firstly, the medium-term confidence at a producer level out to the next 12 months is in fantastic shape. Water availability and grass availability is high, and that is underpinning that, continued confidence in joining larger numbers of females and continuing to increase numbers. So beyond that, we're expecting this year that breeding female numbers will return to pre-2019 levels. And as I mentioned about that grass and water availability, the reproduction conditions for females is very good. So that'll mean improvements in branding rates or branding rates remaining high, and then obviously mortality rates to remain a little lower, barring any abnormalities in seasonal conditions, which will support that improvement. Within that and the breeding females, we know that they're going to be large. There's going to be a larger number, but also I think we know that the investment commercial cattlemen have made in genetics over the last 2 years, it's clearly evident in the way bull prices performed. How much investment producers have made in genetics is really underpinning the productivity of the national herd, and we expect that because of that such intense investment in genetics to improve net feed intake, fertility, growth rates, things like that, that's going to last now beyond this year and well into next year because of that investment. When we look beyond that and we look at the stock turnoff rate, it will hit, or it's estimated to have hit its lowest level on record in 2022. So it reached 24% last year, and that's well below that long-term average back to 1990 of 31%. So what that's telling us is it's basically the number of cattle slaughtered and the number of cattle sent to live export as a percentage of the total. When it hits such a low level, we know that retention of animals has been very, very intense. And as a result of that, it's evident when you look in slaughter numbers, lowest in 37 years. When you look at yardings, they're well down on 2021. That's clearly indicating that the retention of animals on farm has to be delivered to market at some stage, and that's naturally growing the size of the herd. And beyond that, as I mentioned about the retention of females, the female slaughter rate reached its lowest consecutive level over 15 months on record, which eclipsed that 2010 to 2012 period, which was when we last had those consecutive La Nina events. And then beyond that, we saw that significant rebuild in cattle numbers as well. So that retention of females, those commercial cattle producers operating really intensively on purchasing good genetics, improving the production and productivity of the herd, are all contributing to the expectation we have and the forecasts for the improvement in cattle numbers out to 2025, Brendan.
Okay, so we'll stick on herd size. So Steve, we've covered the herd dynamics for 2023 and its drivers. Moving to a national perspective now, what are the forecasts for the herd size this year and out to say 2025?
So it's encouraging, Brendan, that where we've come from and where we're going. So we've had significant growth in the herd in 2021 and 2022, and that was largely fueled by Southern Australia. Now we move into really seeing what the rebuild of the North can do. This year we've got the herd growing 4.5%, and at 28.8 million head, that'll be the largest it was since 2014, which is a really sort of coming off our second last wet period. And so what we have got factored in is we've got growth of 4.5% this year out to 1.8 in 2024 and 0.8% growth in 2025. So that tapering off is as weather conditions sort of normalise and turn. Like we said in the assumptions, given the water that's around, we don't expect there to be a significant liquidation event this year. So that's why we get that growth of 4.5 this year. I suppose Rip's talked about the points, but I just want to reinforce them that we have had three successive years of improved seasonal conditions, and we've had the lowest slaughter in 37 years for 2 years running. So that is what is reflected in such high herd numbers that we're seeing and sort of continued growth in the herd. When we move out to 2025 and we get to that over 29.6 million head, that's going to be the largest that the herd has been in 46 years. But the reasons are reduced slaughter for 2 years going into 3 this year. Even where we have slaughter pegged, will be well below the 10-year average. So those low slaughter numbers, increased seasonal conditions, are really what is driving that herd. So that's where we get to there. Even this year we'll be above the 10-year average, and we'll start moving above the 10-year average for where the herd is.
Good stuff. I'll move into live export. This is probably directed to you, Ripley. Live export volumes reached 10-year lows in 2022, with a number of factors, both domestic and international, affecting numbers. So what are the forecasts for 23 for the live export numbers, Rip?
Yeah, Brendan, you've rightly pointed out that 2022 was a tough year for the live export sector, and it can't be ignored. Clearly, the discovery of 2 exotic diseases in Indonesia did effectively significantly impact the trade for a period of time during the dry last year, when traditionally you'd expect larger numbers of cattle to be shipped. On top of that, there's obviously the attraction of lucrative southern markets for producers that typically sell to live export to then sell into the south to capitalise on those cattle prices. As well as that, as a general statement, the larger or the consecutive wet seasons that didn't really stack up has been below average to drought conditions for a large part of those live export regions affected it. And those contributing factors that I mentioned all coming together in 1 year is a significant challenge for the industry. But when we look at the back end of last year, there was certainly some positives emerging. So the October 2022 month for live exports was the highest it had been since August 2021, and numbers ticked over 600,000 head you mentioned, but that improvement as the numbers strengthened or exports strengthened in the trade for the back end of the year, that's indicating that there are still cattle available and there is that demand from Southeast Asia. We know how important the delivery of our cattle are to those consumers and the impact that makes on their lives. So there are when you look at the economic forecast, that growth in Southeast Asia is significant. And that's what we're expecting to see in terms of improvements in live exports this year to 619,000 head. Industry consultation from within what we said, within the projections itself, suggested up to 660,000 could be sent, but our modelling suggests 619,000. When we look beyond this year, it's going to jump to 680,000, or that's the forecast. Beyond that, back to 750,000, which was where it sat in 2021. So there's certainly significant upside to where live exports can go. And as Steve mentioned earlier, there's obviously also the consideration of the record flooding in the Kimberley-Pilbara regions. And as Steve mentioned, it's not possible to quantify what that means then for those cattle up there and if and to how much extent that will impact live exports as well, just to be made a note of.
Thanks, Ripley. I'll just give a reminder to all that I know there's a fair bit of detail we're covering fairly quickly, but this webinar is recorded. All the details will be available to all at the completion of this webinar. So I know we're getting through a fair bit of data and information quickly, but it's all recorded and will be available to all attendees. So let's move on to slaughter. As I put it to you earlier, Ripley, 2022 was a historically tight year in terms of cattle supply, particularly at a processing level. So what are the forecasts for 2023 moving forward for slaughter?
Yeah, thanks, Brendan. So the situation with slaughter, as you rightly pointed out, through our industry consultation, which we conducted in December, the key issue from the processing sector was labour. We've recognised that in a 2-scenario forecast for this year. Our first scenario expecting normality in terms of labour availability and the actual supply of cattle into those processing plants forecasts that will reach 6.65 million head for the year. That's still well below the long-term average of 7.8. And that's probably still the fourth or fifth lowest year in 37 years. But it is an improvement on the 6.15 we'd forecast for last year, and that 6.15 figure was overstated anyway. So there is upside and the growth looks significant, but when you consider how low the slaughter volume is, it's actually not that much. The second scenario being that the processing sector can't address its labour issues. We're forecasting 6 million head to be put through the processing plants in 2023. Those numbers will be around firm if they hit 6 million on what 2022 will end up being. So the key constraint this year for slaughter numbers will be labour, and it'll be a closely followed trend within industry. And that's the feedback we received as the key determinant of cattle slaughter performance by processors when we did that consultation. Looking beyond this year, in 2024, we're forecasting 7.2 million, again, well below the long-term average, and out to 2025, 8 million head forecast to go through the processing plants. That's a lot more reflective of where we see the herd size in 2029, and it's a lot more reflective of the herd size at that point. So yes, there's improvements in the long term, but this year, definitely labour and the processing sector's ability to address those issues will be what determines and delivers that outcome in terms of slaughter volumes.
Yeah, good stuff. Let's move on to the feedlotting sector. The feedlot sector itself continues to position itself as a major role player in the Australian cattle market. I'll put this question to both of you. What is the outlook for the sector in 2023, considering that the current input price pressures and the tight margins that are currently in the sector? So start with you, Steve.
Yeah, thanks, Brendan. So I suppose the key point to start with is that 2022 was a very strong year for the grain-fed sector. There are a lot of records hit in 2022. In early 2022, 60% of Australian beef consumed was grain-fed and 60% of beef produced separately to that was grain-fed. So the grain-fed sector made up an increasing percentage or proportion of total beef consumed and also produced in Australia. On top of that, in September 2022, capacity, so that is the total number of head that Australia can have in feedlots, reached a new record of 1.511 million head. So that means that feedlotters are investing in putting more pen or investing in building more pens and seeing really hopeful future in the industry. And then the other record that was hit for the feedlot sector in 2022 was in the March quarter. 1.27 million head of cattle were on feed in Australia. So all of those points, the fact that we hit record capacity and record number of head in a year of a rebuild shows that there's some structural things at play, and that the growth in the feedlot sector is something that's here to stay and to continue. I would say as we head into 2023 and there is an uptick in supply and slaughter, we will see some of those, or increase in grass-fed animals coming through and females coming through. So we will see the proportion of beef that is grain-fed fall, but the actual number of grain-fed turn-off remain the same.
Yeah. Ripley, you got something to add there?
Yeah, thanks. Just to follow on from Steve's point, when we look more specifically at the production fundamentals of what this feedlot environment from our latest September lot feeding brief data suggests, we're expecting an improvement in feedlot buying demand in the market. So because national utilisation, which measures the number of cattle on feed relative to pen space or capacity, is quite low across all the states, and it's below sort of longer term averages. And as a result of that, this does reflect further down in our presentation around prices. We're expecting improved feedlot demand this year because of that capacity to fill more pens. As naturally the pen space and capacity in Australia improves, we expect that buying demand from feedlotters to increase at some stage throughout this year. So it is something to consider and think about. And when we discuss price, the industry analyst forecasts, excluding MLA, do align with that expectation for improved buying demand from feedlotters. Brendan.
Okay, so that leads to a discussion on carcass weight. Steve, with Ripley's insights forecasting an improvement in slaughter and seasonal conditions providing plenty of grass available in paddocks, how are carcass weights forecast to perform over the next 3 years, considering in 2022 carcass weights reached a record high?
So that's the point, a key point I think to touch on there, Brendan, is we've got carcass weights in the projections as we move out to 2025, sort of coming back to the 5-year average, but we are coming off some record carcass weights. So through 2021, 2022, we hit record carcass weights, 320 and above and there was a few things that drove that. There was the prices. So we had record prices in 2022, which incentivized producers to add additional kilos onto their animals. Those that were, even though grass-fed was a smaller proportion of slaughter, those animals that were grass-fed were heavier because there was an availability of grass. Also, the increase in grain-fed proportion, which grain-fed animals and tend to be or higher sway towards steers, lifted the carcass weight. So they are the reasons that we've had record carcass weights in 2022. Going forward, next year in 2020, or this year in 2023, we've got carcass weights at 315 kilos, easing to 308 in 2024 and finishing the projection period at 302 kilos, which is still higher than anywhere they'd been before 2021. So we have carcass weights in a really strong position. But they will be softening, and there'll be a few things. There'll be more females come through that being processed as we go through this projection period. There'll be more grass-fed animals going through in this period of the projections, and prices are not at the record highs that they were last year. So that's where we've got carcass weights. But encouragingly, and the trend that we expect to continue is if you see that yellow line, that constant trending upwards, is driven by improvements that producers are making in management and genetics, and we do expect that trend to continue. So we will see that continual upward trend over time in a longitudinal space increase over time.
Okay, so Steve, as a follow-up to that in regard to production, what does a decline in carcass weight mean for production with slaughter improving, and how will this affect the industry's overall output moving forward?
One of the interesting things that's sort of the inverse of the position that we've been in this year, Brendan, where we've had periods of the record carcass weights offsetting some of the reduction in slaughter. Like Ripley said, we had the lowest slaughter in 37 years. So in periods of record carcass weights but low production, the carcass weights, slaughter, offset some of those production dampening. As we move forward, the production won't grow by as much as slaughter because carcass weights aren't going to be at the record levels they are. But encouragingly, we do have production, as you can see on the screen, moving from 1.9 million head through to 2.4 million head as we go out to 2025. And that's reflective of those sort of 2018, 19 levels. But that is as we move out further to 2025. And what that means is it allows us to provide some will allow Australia to fill export demand for this product. So as the production increases over time, so will the ability for Australia to fill export orders, which is a really encouraging piece. So that's where we're heading out over the longitudinal with growth over 30% in production over the next 3 years, Brendan.
Right. Okay, we just might move into a question briefly on the EYCI to yourself. Ripley, cattle prices have been hotly discussed topic to begin 2023, and the projections provide insights into what industry analysts are forecasting for price over the next 6 months. Can you elaborate on where these industry analysts see the EYCI out to June this year, for example?
Yeah, thanks, Brendan. So for each projections, we do forecast young cattle prices via the EYCI, and we want to thank Rabobank, Mercado, NAB, Episode3.net, Auctions Plus, and ABARES for providing these insights. They're their forecasts, not including MLA doesn't forecast price, and this is their expectation for price to reach by the middle of this year, 30 June, say. So they're forecasting that the EYCI will reach 811 cents. And what that means and what that's telling us is it's an uptick on current rates and where that indicator is sitting at present. And then also when you look at the longer term performance, it still remains around 8.5% or 60 cents a kilo carcass weight above the 5-year average. So from the current situation, these industry analysts are forecasting an improvement in price from the rates it sits at present. But when you look over the longer term, even including the record years of 2020 to 2022, it still is forecasting that price to be above the 5-year average. So the demand for young cattle clearly is recognised by these analysts to improve to an extent.
Okay, so now that we seem to have covered the broader market, let's move on to feeder steers. Ripley, you've made an exciting inclusion of utilising industry analysts to forecast the feeder steer price as well. So can you explain why you did this and where they see the market performing to, say, the middle of this year?
Yeah, and it is an exciting development, and we're excited to include this. And again, want to thank those 6 analysts I mentioned previously for their contribution. They've provided these forecasts, and the reason we've done it is the feeder steer is an actual transactable animal in the market. As we know, the EYCI isn't, whereas you can transact a feeder steer, and we want to provide that to industry and to users of these documents to understand where a transactable animal is expected to perform. So out to the middle of June again this year, these analysts have forecast the feeder steer price to reach 420 cents. Again, it's an uptick of around 25 cents a kilo live weight on current rates. And similar to the EYCI, there is that forecast for an improvement in prices, which aligns with higher than average, sort of higher than 5-year averages, I should say. So again, it's about an 8% increase on the 5-year average price if this feeder steer price reaches 420 cents by the middle of the year. And as I mentioned previously, after Steve spoke about the feedlot sector, this price improvement reflects that expectation from MLA that we will see an improvement in feedlot buying demand, which that increase of feeders operating in the market and competing with other buyers does reflect these analysts' forecast for improvement in price as well.
Good. Following on from that, Ripley, you also utilised the StoneX feeder steer price forecast out to September for this particular release. Firstly, why have you done this? And secondly, how does StoneX product on forward pricing cattle look, and what can producers expect?
Again, thank you to StoneX for providing this information, and this is an offering that is basically what you're looking at right now is the mid-market mark, which is the middle between bids and offers for stakeholders competing in that market for bids and offers, and it's basically split down the middle of where those two prices sit. And what the reason why we've done this is again to show a financial offering that's being used in industry as a tool, to manage risk and those kinds of things. So what StoneX and what this price tells us is similar to the industry analyst forecast. They're expecting an improvement in price out to $4 by July 2023, but that's not before a softening in price in February this year, before that gradual improvement. Again, aligning with the expectation that we should see improved feedlot buying demand to fill that pen space and that capacity that's available because of the lower utilisation rates.
Good. We'll now move on to global dynamics and what any changes may mean to our key competitors and where that will position Australia. I'll throw to Tim Jackson, who is our business analyst in the market information team, who's been sitting there waiting patiently. Tim, we know the US is a critical cog in the global beef market, and over the last few years have had a significant herd liquidation affecting Australia's market share in key global markets. What are the forecasts for the US supply in 2023, and what does that mean for Australia? Thanks, Tim.
Great, thanks, Brendan. And just to put into context how rough the drought's been over at the US over the last year or so, last couple of years, the USDA published some figures yesterday that speak to how difficult a time it's been and how much that's elevated production. So we found out that the total US herd is about 89 million head, which is the lowest since 2015. And of that, only 29 million are beef cows, which is the lowest that's been since the 1960s. And at the same time, we saw the FSR, as the chart shows, above 52%. For 2022, which is the highest that we've seen that indicator since the 1960s. That means that US production has been very high, and their exports have been especially high in that over the past few years. That's eaten into our market share in the countries that we both export to and slowed down beef exports like from Australia to the US itself. Given most people, including us, are assuming a shift away from the La Nina dynamic at some point in the near to medium future, the US cattle herd is likely to enter a rebuilding phase soon. So the USDA is forecasting that production will be down 7% in 2023 to just over 12 million tonnes, while exports are forecast to fall 13%, and the US is forecast to shift back into being a net importer. Over the last few years, they've been a net exporter of beef. So this will give us an opportunity to rebuild some of the market share that we've lost over the last few years in places where we directly compete with the United States, like Japan and Korea. And it'll also give us an opportunity to boost our exports into the United States itself as they shift back into being a net importer. And the other thing that'll be useful here is that drop in American supply will hopefully keep demand fairly firm and help support prices in the global market. Even if there are some macroeconomic headwinds around the world, it should help to keep prices a bit more stable than they otherwise might have been.
Yeah, good stuff. Thanks, Tim. But finally, another question to you. Brazil has become a major player in global export markets, but its exports are more affected by factors not very similar to either the United States or Australia. Can you explain why this is and what some of those changes may mean for Brazilian exports in 2023?
Yeah, so if we think about how the industry broadly works in Australia, every year Australians eat about as much beef as they did last year. And if there are changes, they're fairly slow. And so that means that when we see changes in production, that mostly ends up being reflected in our export volumes because the domestic portion stays fairly stable in kind of tonnage terms. That hasn't been true for Brazil over the last decade. what we've seen is that their exports have roughly doubled in like volume terms, but their production has stayed relatively stable over that period, just with the kind of standard cattle cycle variation. What that means is that their domestic consumption has dropped. And the main driver behind that is a shift in purchasing power between Brazilian consumers and consumers in other bits of the world, primarily China. So there's been a lot of economic growth in China, as we all know, and that's created a lot of consumers for imported beef. And at the same time, the Brazilian currency has declined in value against the US dollar and against the yuan as well. So that's severely cut into the purchasing power of Brazilian consumers and made it more profitable for packers and processors to export meat to China. Now, the reason that this is important and is kind of a new dynamic that's a little bit difficult to forecast is that it means that the exchange rate, specifically the Brazilian real to the US dollar, ends up being an important determinant in terms of the volume that ends up on the global market. We're pretty used to understanding exchange rates as being important in setting price and in terms of revenue, but having the biggest exporter in the world by some margin, having its export volumes to some extent determined by exchange rates is a new phenomenon that might mean that things end up being a little bit more volatile in the kind of total global supply sense of things. But it also probably gives us a bit of an opportunity because we export so much and because our export volumes are determined by production. It means that we're able to be quite straightforward and quite steady with our partners overseas. And if we're able to, provide them kind of good information about how the herd's going and how production is going, we'll be able to offer more reliable shipments than some of our partners might be able to. So the market will probably be a little bit more volatile over the next little while, like globally, and that offers an opportunity to us to, be the kind of stable, reliable partner in that.
Great stuff. Thanks, Tim. Good insights. Just before we move into the questions that have been provided to the team, just a reminder once again that the full projections document has been released on Tuesday on MLA's website under the Trends and Analysis page, and they'll also be circulated in tomorrow's editions of MLA Weekly Email Newsletter, The Weekly. So everything that's been discussed here today is being recorded and fully available to everybody that wishes to take advantage of that. So before we go into questions that have been received by people who are participating in this webinar, just to Steve, Ripley and Tim, thanks for your insights. Your responses have shed significant light on how 2023 could shape up for the cattle industry. So guys, I'll throw over to you because the questions are coming. You'll be able to see the questions and go through them. That's the topic that's related to what you were discussing. So I'll let you take the questions as they come through.
We've got a question. Cheers, Brendan, from John that's come through around the confidence in the model and getting to 28.8 million. So around that is we use a systems dynamics modelling, and we work with University of Queensland on that to build out that model. Underpinning that model is sort of ABS data back to the 70s, BOM data back to the 1990s and then 1900s, and then also peer-reviewed literature. So we've worked with UQ on that, and that's the model that we use. Also, when we do a first run of the model, we then run out to the major pastoralists and processors and test and stress test our numbers. And so we are extremely comfortable with that 28.8, given it's been through those, the peer-reviewed model. It's got those data points, and then that we've tested the numbers with industry.
Rip?
Yeah, I don't think there's anything else to add there from Steve's point of view. But as he did mention at the start in his content related to the herd, you do have to think about the significance of how intense this rebuild's been and that relationship between retention of females, the improved productivity that we know producers have invested in, 3 consecutive La Niñas. You know, this is the third it's been since 1960 or 1970. So all of those contributing factors have played a significant role in this development and this improvement that we're forecasting. And to Steve's point, the capacity of our model to recognise adjustments, changes, and the weather and the significance of that, even despite the fact that we are forecasting or building into the model an El Nino out to or within the next 18 months, that yes, the herd size is tapering, but the growth is there and it's underpinned by that those key production fundamentals I was talking about, you know, the FSR being so low and that stock turn-off ratio.
Thanks, Rip. Steve, there's another question there for you.
Well, Rip, I don't know if you want to answer this, but given what we obviously go out to processors and we use a lot of BOM data that underpins the model as well. So the BOM data that underpins it shows that there is no part of Australia except a tiny bit of northeastern Northern Territory in drought. We do know that the rainfall of the last 3 La Niñas hasn't necessarily been uniform. We know some areas have received rain in the 2020/2021 wet season, some last year, and then it was a bit more widespread this year. We do know that those average seasons didn't necessarily break the drought or that didn't provide the pasture density or the pasture growth that was there, but those average years that are being supplemented by the wet this year and through our consultation, they do think that the herd can really rebuild this year up in Queensland.
Good, thanks, Steve. Rip, there's another question there with you.
Yeah, I will jump on that. And I'm not sure who it's from, but thank you for asking. It's saying, do you have a feel for the number of long-fed cattle on feed and the impact of this on feeder steer demand? So yes, we do. We have data in relation to the number of grain-fed cattle turnoff. So the number of days that they were on feed, not the actual number itself on feed at that one point in time, but the number of cattle that were turned off out of a feedlot to a processing facility and how long they spent on feed. So the data from the latest September quarter is telling us that around 13% of the turnoff for that quarter was cattle on feed over 200 days. So it was about 6.5% split between 200 to 300 and 300 plus. That is sitting around 2% above the quarterly average back to the financial year of 2015, and the September quarter itself was actually higher again, so at 14%. So 14% of the total grain-fed turnoff was cattle that were fed over 200 days. So then obviously when you look at the actual numbers on feed, you can assume that percentage is higher for those actual cattle on feed as well. In terms of the impact that may have on feedlot demand, it's probably quite tough to quantify, but back to those price forecasts and that expected improvement in demand from feeder buyers, there's obviously support there for that. And we know, being such an important exporter of that really high quality grain-fed content cattle, that will play a role then in how the domestic market works and satisfying that demand internationally, as Tim just mentioned, when that reduction comes in US grain-fed supply into those critical markets which we compete with the US in.
Right. Okay, you've got nothing else there, Steve?
Oh, there's one. There's a few more rolling through. So from Carl, is there a fix available in regards to meat worker shortage? When we look at the Home Affairs, they do migration planning every year, and this year they expect 142,000 skilled workers to enter Australia, and that's 79% up on last financial year. And even if we go back to pre-COVID levels, the amount of skilled migration expected to enter Australia in this financial year is 29% above pre-COVID levels. So going back to 2018-19, of that, 34,000 of the places of these skilled migrant places are reserved for regional Australia. So that's really encouraging for beef, the whole supply chain, but also processors. I suppose the point I would make is that is what migration planning estimates forecast, and we hope that's where we get to, but whether we actually can physically implement those numbers is probably yet to be seen. The PALM scheme has been relatively successful, so that's another fix that's in the work or solution. So there are hopefully a few things on the table that will allow us to get there. Whether they come to fruition yet is sort of yet to be seen.
Thanks, Steve. There was one question I think came through in relation to the producers having reduced the age of their turnoff rip.
Yeah, thanks, Brendan. I'll just grab it up. And the question asked was, do you have any thoughts on how many producers have reduced their age of turnoff over the past few years and how this will affect grass-fed slaughter cattle numbers? So we know a massive part, of producers and cattlemen purchasing genetics. Obviously, growth rates are quite important, and it also has a lot to do with the doability of cattle and their potential to put on weight and their feed efficiency, dependent on how those seasons allow as well. So yes, it's obviously a contributing factor, and we know the vast majority over the longer term of cattle processed in Australia are grass-fed, and they're based on a grass-fed production system. How it'll affect it, as Steve mentioned, we expect that improvement of grass-fed cattle percentage as a total of the slaughter to increase. And I suppose to recognise Steve's point more is even though the number of grain-fed cattle turnoff won't reduce as a percentage, as an actual total, the percentage will, because we're expecting that increase. And yes, those improved genetics that producers have invested in will contribute to a lift in those numbers, and that turnoff age is dependent, probably to loop it all together, on how those cattle cope with seasonal conditions and their ability to put on weight during those sort of tougher, dry times as well.
Brendan, I'll jump in to answer a few. There was a question from an anonymous of the split of beef and dairy. So the split is last ABS data has it at 90.3%, and that's around where ours sits, between 90 and 91% beef, and the remaining 9.7% dairy. I'll just follow that up with Tim Ryan. Good to see you on the call. Kills out to 2025 at that 8 million is assuming that we return into normal, that has got factored into an El Nino year. The piece around the slaughter growth, I suppose, is the year-on-year growth that we're seeing from 6 to 6.6 and then through to 8 are record percentages year-on-year growth. Though as a total, 7.8 is the 10-year average for slaughter. So we know that we can process 7.8, provided seasonal conditions are right, reflect the long-term average, and we can get labour. So we do expect that kills out to 24-25 to increase, and that's why we've got in 2025 at 8 million. That is above the 10-year average. And we update these projections throughout the year, and then we'll obviously do one next year. And there could be updates to what the 24 and 25 slaughter figures are, if sort of there's some significant changes to seasonal conditions.
Yeah. Is there another question coming there to you, Rip?
Yeah, just quickly, I suppose, to add to Steve's point, Tim, when you look at slaughter between 2012 and 2015, as you say, ignoring labour issues, the increase and improvement on those numbers out to above 9 million in 2015 means that, yes, it's definitely possible. An increase in numbers obviously depends on season, and if the season continues, to remain sort of average, or producers have got the capacity to retain stock on farm and whatnot. But we've seen it jump significantly before, and there's no reason it can't do it again, ignoring the conversation around labour constraints. The question, Brendan, that you put to me earlier, there's one from another anonymous person. Are you expecting a backlog of grass-fed cattle slaughter if processors can't lift throughput? The issue around that will reverberate along the market, dependent on processors' ability to deal with it. So it'll affect carrying capacity, it'll affect land management for a period of time for those producers, and then further down the supply chain, cattle get too heavy, fall out of spec for certain markets, things like that. So do we expect it? Well, yes, we've provided those two scenarios for that reason, to provide that insight of where it may operate at. But Steve, I don't know if you had anything else to add to.
I don't think we think it will happen. To Rip's point, we don't know. The piece is we don't, but we have provided two scenarios in there. So what we've touched on what the consequences could be, but we don't expect that.
Okay. As I said earlier, that we still got a few questions to get through, but we're coming to the end of our time. And as I said earlier, every question will be responded to in an appropriate manner, and fairly soon by Tim, Steve, or Ripley. So bear in mind that if your question hasn't been answered, it will be answered in the short term. When we follow up when we finish with this to webinar. So don't be concerned that you won't be answered to very quickly. So I'd like to thank everyone who's come on here today to participate in this webinar, to all those registrations, and we certainly do appreciate taking time out of your schedules to be involved in the Projections 23 webinar. And I'll hand over now to Ripley in regard to, I think, what's happening with the similar lines for the sheep webinar coming up. Ripley.
Yeah, thanks, Brendan. And just to bring to everyone's attention, we will be running a webinar similar to this for sheep projections on Thursday, the 16th of February at 11 a.m. Australian Eastern Daylight Time. The format will be very similar. We'll cover similar aspects and content, and do encourage anyone and everyone that's interested, please share it within your networks and and share that far and wide and join us there on the 16th. But finally, I'd just like to say thank you for everyone for giving us an hour of your time. We do appreciate it. And if there are any queries you do have or you'd like to discuss with us further, please touch base with us, give us a call, and we'd be happy to chat. So thanks very much, and thanks to Steve, Brendan, Tim, and the broader market information team for their contributions today. Have a wonderful day.
Thanks all. Thank you very much.